You've probably heard of the stock or company I'm analyzing in today's video, and if you haven't, I don't know how, but you have probably used one of their products, whether it's Listerine, Tylenol, or Band-Aids. It's Johnson & Johnson. That's the company we're looking at today. And in today's video, we're gonna be talking about the recent pullback in the stock and why I think it's personally a good buy for the long term. Speaking of the pullback in the stock, Johnson & Johnson had a pretty good run year to date up until mid-August, and then after that, the past few weeks, the stock has just gotten absolutely hammered to the downside and is closer to its 200-day moving average around 163. And this move in a company like Johnson & Johnson is significant because it has a beta of 0.7. So normally stocks like Johnson & Johnson don't have these huge pullbacks quite often. If you're not familiar with the company, essentially it's a mega cap healthcare company, and they operate quite diversified. So they have consumer health sales as well as pharmaceutical and medical device sales. When it comes to familiarity, you probably know the consumer health brands like Listerine, Motrin, Neutrogena, stuff like this, but that's actually the smallest percentage of sales. Most of their money or revenue is brought in through pharmaceuticals, followed by medical devices. But a lot of these names you're probably not as familiar with. Also, it's important to mention that this company has been around for a while, since 1886, and it's already gone global, meaning that the revenues coming in from international sales is around 49%. So it's pretty close to a 50-50 split when it comes to US versus the rest of the world sales. Now, with a market cap of in the $400 billion range, this company is no longer a growth story. But what's nice about Johnson & Johnson is it's not actually a slow grower, it's more of a stalwart. So it's still growing its earnings per share, and it's expected to continue to grow as a company going forward because of the industry that they're in. Healthcare is still a growing industry. The macro environment for this company is good for the long term, because if you look at the segments that they operate in, consumer health, pharmaceuticals, medical devices, all the compounded annual growth rates for these industries on a global level are expected to continue to grow between 5 and 8% through 2025 or 2026. Also, if you got a soft spot for dividend payers, well, you're gonna like Johnson & Johnson because they are one of the oldest dividend aristocrats on the list. And if you're not familiar with that term, dividend aristocrat, that means a company that has continually raised their dividend payout every single year. And Johnson & Johnson has been doing it for 59 years. So they're in an elite status between companies like Coca-Cola, 3M. These companies continue to raise the dividend while continually paying it out every single year. And what's nice about Johnson & Johnson is they continue to grow their earnings per share at a decent pace. So you're getting an increasing dividend and a growth in earnings per share. And if you're wondering what kind of growth rate they have on their dividend, it's between around 6 to 7% over the past 5 years. So you can see going back all the way to 2014, 2013, it's pretty consistent between that 5 and 8% range. And when it comes to payout ratio, it's around 61%, meaning that they have enough net income to cover that dividend payout to shareholders. So the thesis on this investment for me is really coming down to cash flow as well as stability. So this company on a cash flow basis, in my eyes, looks pretty good. So let's jump into the financials. First thing I usually look at is how much debt a company has versus how much in liquid assets they have. And right off the bat, in the Q2 earnings report, they actually call this out, net debt of $8 billion. But from a free cash flow perspective, they're generating around $8 billion each quarter. And they are putting that money to work. So whether that's the dividend that we talked about or investing it back in R&D, the company is going ahead and investing it instead of drastically paying down that debt. I mean, I'm not too worried about it because we're talking about $8 billion in free cash flow per quarter. This isn't a yearly number. So even if they throw a little bit of this money towards that debt, they can work it down to levels that aren't really a concern. And anyway, for the company, cheap debt right now is fine to use if it's going to be fueling stuff like R&D, which should grow earnings expansion or revenue expansion. Some other positives when it comes to looking at the financials is, one, the company has a good return on equity of around 27%. So that means the company knows how to use their capital to return that value back back to shareholders. Operating margins are pretty solid at 26%, and they have a PEG ratio of 1.67. So in a market like we are in today, and with a company like Johnson & Johnson, having a PEG ratio of under 2 is pretty nice. And as we talked about, they have that dividend to boot, around 2.6%. Let's talk about the guidance that they provided as the important piece of this. As you may have been wondering, how much in vaccine sales has the company had? Around 2.5 billion is the expected full year sales for the vaccine, which we'll talk about later, whether that's an opportunity or a risk. But essentially, the company is expected to come in around 94 to 95 billion in revenue. And with that, the adjusted EPS is expected to be around $9.65 per share. I don't want to sound like a broken record, but this company is financially stable, has good margins, and it seems to have all of their financials in order. So with a cash flowing business like Johnson & Johnson, I use a discounted cash flow model to predict the fair value. Using those guidance numbers as a base, along with some operational improvement in margins expanding around 0.5% each year, around 28%, which was achieved in prior years, so I think it's possible. And the revenue's kind of stable through the next 5 years, right? Not a ton of growth. When I say ton of growth, I mean like 20%. But having something range from 4 to 5% is very reasonable for this company. So using conservative estimates, I come up with a projected fair value of around $199 for the stock. That's a 20% upside from the current values. So with a company like Johnson & Johnson that has a lower beta, this kind of stock adds stability to my portfolio while also having that nice little dividend cherry on top. Now, looking at the technical setup, it's looking pretty good from a long-term entry point because the RSI under 30, so it's a little oversold. The MACD divergence is looking like it's turning bullish as it kind of curtails here, and it's right around that 200-day moving average support level. As for risks and opportunities, let's talk about the vaccine sales because that's around $2.5 billion for 2021. And now the question is, will that go away over time, or will they kind of make the same amount of revenues slowly, or that will slowly get phased out as there's herd immunity? Maybe they kind of bolster that up with booster shots. Who really knows? What's good is, in my eyes, $2.5 billion in sales is something that the company can kind of eat and not get absolutely destroyed. If vaccine sales was 20% of the revenue and all of a sudden that was disappearing, that would be a much bigger hit in my opinion. I think the company, even without those sales, is still a good value at its current prices. So there you have it. There's my opinion on Johnson & Johnson and why I'm personally adding it to my portfolio. If you did enjoy the video, make sure to give it a like, as well as consider subscribing to Main Street Wolf, where we talk investing, stock options, anything to do with money. Thanks guys for watching, and have a great day.